Before we get more into the weeds on Fed policy and central bank policy around the world, what does a global bust look like to you, David? Is it a dramatic sell-off and crash, or is it more like a grinding contagion that spreads from sector to sector over the course of you know several months?
Yeah, well, again, bust refers to what makes it a bust is it's a bad recession, but then it's accompanied by a financial crisis. So the most classic one to point to is surprisingly the one we just had in 2008-9. I think that one I don't call a bust because we kind of pulled back from the cliff. We were on the edge of the cliff, and when they almost shut down the commercial paper market, which would have really hit some big corporations very hard, and others, um, they acted just in time to avoid a bust. This time, I think just the mindset, that our central banks say we're never going back to that place again. We're not going to do QE infinity. We're not going to, means there's going to be a lag to when we respond properly.
Mhm.
And it's in that pause, in that delay, that I think we can go over the cliff this time. So it's basically 2008-9 on steroids is what I describe it as, which means for a short period of time, if you can imagine October of 2008, if they hadn't made sure the commercial paper market stayed open, if they hadn't bailed out the banks immediately, et cetera, we could have seen the bust then.
Mhm.
This time around, I think because it's the next cycle, basically, um, they're going to be very reluctant to repeat what everybody on Wall Street as well as on Main Street thinks was a mistake.
Mhm.
So it's that delay. It's not that they won't come in; they'll come in bigger than they've ever come in, but there's going to be a delayed response. So I mean, you can see it already in terms of Powell and the Fed. They're still fighting the last war. They're so worried about inflation right now, and they think they haven't learned the lessons of the past of leads and lags, and they're kind of everything is they don't want to make mistakes, so everything is right to the minute. It's like what was CPI this week? What was the jobs number last month? And the leads and lags to policy are 6-9 months at least, and so you're guaranteeing you can be late. And when you have the leverage we have in the system, that lateness is a problem. So I'd say a bust. I think overall the cycle will be not necessarily any longer than 2008-9. I've said the bust itself maybe 12 to 18 months. The market will lead the bust coming out. So the bear market might last 9 months. It's or it could even be faster, but it won't be 2 months. You'll have different legs to the bear market. It won't be straight from top to bottom.
Mhm.
You might go down 30%, come back halfway, go down, another 40 or 50%, come back halfway, and then have a final sell off. So it'll take, those consolidation or bear market rallies might last a month or two.
Mhm.
So it all depends on how much those counter rallies, how much time they take as to how long the bear market lasts. So, could be a year, but it might be shorter.
Mhm. It's interesting to think about the nuance of how the Treasury and the central bank are operating right now, and how in a way we're coming quite close to the end of Powell's term, right? He's done at the in May here, but I was listening to Secretary or Treasury Secretary Bessent the other day in a bit of a longer form interview, and he was talking about the idea that they're not against coming in to make sure that if there's a liquidity crisis that they respond accordingly. But as you're saying, they don't want to completely support Wall Street and the stock markets. But in a way, what he's kind of signaling is that if there's more so a banking crisis or a specific liquidity crisis, that they're willing to step in that case. So do you think that there is, a little bit of a shift of strategy considering Bessent's words, and also the idea that maybe the new Fed chair is more aligned with a strategy like that?
Yeah, for sure. I think you're going to see as we move towards May that the Fed will not be fighting the administration like they are now. I really um, am torn because I do think Powell can be a little political.
Mm-hmm.
And by now, I mean, Trump's alienated him for sure by calling him a moron, etc. So even if he's trying to be objective, it's hard for anybody to be objective when that's who you're facing, facing off with. Um, but generally, I would, as I said before, you can't fault the policy, and it's not just Powell. And it's not because he's browbeating him. He's got most of his committee pretty much in line with his thinking,
Uh-huh.
and there may be some politics there, but more than that, I think they're looking back. They're fighting the last war, or they're overly concerned about inflation when they shouldn't be,
They're
etc.
they're
So
still they're still fighting transitory inflation, right?
yes, right, yeah, yeah, exactly. They don't want to be accused of making that mistake again. That's exactly the war they're fighting. Um,
Well, I
so
mean, David, this brings up a really interesting point, though, is that, you know, we're looking at replacing the Fed chair, which is one vote out of, I believe it's 12, right? So how much weight, or is it basically the overall direction that the Fed chair has influence over the entire committee? And how does that, do we think of the Fed as one person when in reality you need a consensus among 12 chairs?
yeah, every Fed chair has a little bit different. Well, I guess
Mhm.
Greenspan certainly had pretty much full control of his. Volcker pretty much control of his, and I think Powell's got certainly most of the committee pretty much has his back. So the Fed chairs got influence if things are kind of on, where there's the committee is split. His he can weigh in and carry a lot of weight, and particularly when he's got a relationship with the committee like Powell does.
Yeah.
But Fed chair can be overruled if the committee, and if most of the committee, I'm not saying this is the case, but if most of the committee had TDS, it wouldn't matter who the chair was because they would probably fight him, and it would be very dysfunctional. I don't expect that at all, and
Mhm.
frankly, I think the economy is going to be making the decision for them. As I've said for a long time, I'm definitely somebody that supports most of what Trump does, but I've said it's a mistake to be going after Powell, that the bond market sets rates or determines rates. The Fed controls the overnight money. That's it. And yes, the Fed certainly, Wall Street hangs on every word and, on every meeting. But in truth, the bond market, if they see inflation coming down or the economy softening, they're going to move rates before the Fed, even no matter what the Fed wants to do.
Mhm.
So I just think it's been a lot of wasted capital fighting Powell, and you come across looking like a brood. But I get it. I understand he believes that rates are hurting the housing market, hurting the economy, et cetera, and he wants to bring them down. But it's not the Fed. If the Fed cut too aggressively too soon, it can have, as we saw, a year ago, more than a year ago, it can have the opposite effect. Long rates can go up. So you know, I think we make too much as investors, particularly Wall Street, spends too much time talking about who's going to be Fed chairman and what's the effect going to be if Powell stays on or what have you. When we don't like dysfunction, I don't want to see that. but I don't really think it's going to make a lot of difference in terms of the ultimate outcome or even shape of the next year. You know, it's I think we're heading for a bust, no matter who the Fed chairman is. And in terms of the administration, and I think Scott Bessent is the best Treasury Secretary in history. Um, I think we're really lucky to have somebody who not only came from Wall Street, but at least for me, he thinks like I do. I mean, he really does have a control, an understanding of markets and macro in ways that nobody that's been in that place before has. You know, Mnuchin did a pretty good job, and you know, other Rubin was pretty good. I guess that was with Clinton, but you know, Bessent really does have a handle on all of that, and he's also not afraid to speak his mind and some things. You know, he's not a wallflower, that's for sure. And he's well spoken in terms of explaining himself and explaining things. So that's a big plus. You know, Trump still has, you know, when he wants to do something, he'll do it. But and they're pretty much on the same page on a lot of things. What I would say though is that um, this administration, this Fed, Bessent, none of them are looking for a bust. You know, people say, "Oh, do they know this is coming?" But they're just not going to tell the public. Or no, this is something that's totally not on anybody's radar, or hardly anybody's radar, and certainly not any policymaker's radar. So it's going to surprise when it comes. And what I've said about Fed policy, and I think it's true, even if Bessent has inclinations towards, you know, responding quickly, it's not just the quick response, it's right size policy. And if you're going to have something where um, things are coming apart much faster and much deeper than even 2008 9, nobody's going to be ahead of time prepared for what it's going to take to turn that around. And then add in the fact, as I said before, I think the inclination is not to repeat the mistakes of 2008 9. So they're going to be coming in gradually, initially, very gradually and reluctantly, and then realize, like a deer in headlights, oh my God, that's not nearly enough. And then they come with another tranche, that's not nearly enough. And so it's going to take them a good long time to get a good long time in terms of crashing markets and crashing economies. You know, a day is a long time in that environment, or a week or a month. So, but it'll take them time to get the right size policy. In the meantime, things are going to continue to be free falling. So, and if I'm right that we're going to have a banking crisis of a magnitude even bigger than 2008 9, um, you know, you're going to have bank failures dominoing across the world. And again, my focus is the U.S. and the Fed. This is a global bust.
Mhm.
So it's going to take a lot of, and we also don't have cooperation globally. I mean, we've got a lot of, you know, I not sure how Mark Carney and Donald Trump are going to meet in terms of minds immediately. You know, they'll get there because they're going to have to. But you know, there's going to be a lot of that you know, we just we're in a world where people make stupid decisions because of you know, their politics.
Mhm. Well, that's actually, where I wanted to go next is this, you mentioned the idea of a banking crisis. How will banks be affected? And does that, put into jeopardy people's savings that they have held within these banks? And does the FDIC really, the FDIC insurance really mean something at that point?
Yeah, that's one place where I've been pretty adamant um, that you know, the ultimate response is going to be, I think, just looking at the U.S., it could be as much as 20 trillion or more in terms of new QE. So we did 5 QE, 5 trillion QE in response to the pandemic.
Mhm.
We did 3.7 in QE after 2008 9, or in response to 2008 9, and that came over a few years.
Yeah.
This could be 20 trillion coming in, like we saw in the pandemic, coming in over the course of a year or 18 months. Um, that money is going to be used in so many different ways to try to, just like we saw in the pandemic. They did so many new things that they had never done before, and tried to figure out ways to help small business, help Wall Street, provide loans to those that really needed something to just get through this. You're going to see all that again. I'm quite sure, and it means there'll be plenty of money because they'll do whatever it takes to stabilize the system and turn it up. That means there'll be plenty of money to fund. I have zero doubt that the FDIC will be funded to whatever their liability needs are to meet the 250,000 per institution threshold. So if somebody has 250,000 in a bank that's FDIC insured, they'll get that back. Beyond that, I can't know. I mean, I would presume that we might see even beyond that protected, but in Europe and other places, bail-ins are very possible. But I think in the U.S., I'm very comfortable in saying up to that 250 per institution, you shouldn't worry.
It's interesting to try to consider what happens in that case, though. Like, let's say you have less than 250 in, I believe it's each account, right?
And that's
Um,
I think it's each institution.
okay.
Um,
Well, either way, if you
so
think about
you could have three accounts, but if you exceeded the 250, you'd be
total,
above the threshold. So it'll be your sum total in that institution can't go over 250 for the insurance. I think I'm right about that.
okay. So in that case, though, if they come in with, $20 trillion worth of liquidity to, you know, prop up or save the system, that 250, once you adjust it for that extra $20 trillion that is going to be created, the real value of that currency just gets destroyed by that liquidity as well.
Well, keep in mind there are leads and lags. That 20
Yeah,
trillion.
of course.
My cycle forecast, or my long term macro forecast, is that five. As I say, this is my talking about 20 trillion is not an endorsement that that's what they should do. I'm just saying that's inevitable. Is that whatever the number is, that's what they're going to have to do to save the system, and they will do that. I have no doubt. So, but then the lagged effects of that is going to be inflation and ultimately hyperinflation, or what I define as hyperinflation, which could be 25% inflation by the early 2030s. But there's, the first year out of a bust, we're coming out of what I think will be a deflationary bust. So it'll take that first year just to get to low inflation again, and low single digit inflation. And second year you might be mid to above mid inflation, mid single digit. And by the third year, you're approaching double digit inflation, and by the fourth and fifth year, you're roaring straight up like silver is now. Um, so so yeah, it's going to lead to a real purchasing power problem down the road. But in the period where you're in deflation, you're just glad to get your money back, and having your money back while inflation's not moving forward, you'll be fine. It's what you do with that money in the ensuing years that will make a difference
Yeah.
as to whether you're one of those that says, "Yeah, I have 250," just using a number, I have
Yeah.
$250,000, but it now, is only buying me what 100,000 or 150,000 used to buy me. So yeah, that is going to be the problem to this. But as I say, I think it's inevitable that they'll try other things before they get to that. But ultimately, the only thing that can save a free falling system, or the only thing that can move fast enough to save it, is cash, is money. And so you'll see that. You'll see other things. They'll legislate things to try to save pension funds and save the money market funds. They'll probably have we won't break a buck policy again that they had back in 2008-9. Um, but um, but ultimately, yeah, the ultimate result is that we go from this bust into an inflationary cycle that's going to be our undoing, because you're also going to see to do 20 trillion in QE means they're probably going to do something equivalent in terms of Treasury borrowing,
Mhm.
government borrowing, so that, or if it's not 20, it's certainly a big number, so that the amount of debt that I quote the global number of 330 trillion today, by the time we get through the bust and on the other side of the bust, it could be 450 to 500 trillion. So we're not going to be deleveraging in this process. We're actually going to be more leveraged. And then we're going to have that much higher leverage facing 15, 20% inflation rate, inflation and interest rates.
And there's, in exactly as you explained, it doesn't end up being we're trying to save the dollar, therefore we have to sacrifice the bond market. It ends up being the idea of basically sacrificing both through probably undulating, back and forth, push and pull, kind of tug of war. But at the end, we're going to end up with both of those things being destroyed.
Exactly. Yeah. The end result is a dollar that now the dollar will get bid up, I think, in the second half of the bust as people see how bad it is. They flee to the safety of the dollar,
Yeah.
because we're still the safest place. We have plenty of problems, but people will see this as the place where they trust it most, that they'll get their money back. So the dollar gets bid up as people buy treasuries from overseas, et cetera. And so you'll have one last hurrah on the dollar. I'm calling for 82 on the dollar, what I call pre-bust, meaning this year,
Uh,
sometime this year. And then when it starts going the other way, I think you could see 120 or higher on the dollar. So you have one last hurrah.
mhm.
And then I wouldn't be surprised to see the dollar under 50 by the end of the decade. So, and going south from there. Just remember, we're not in isolation on this. It's all fiat currencies because they're all going to be doing the same thing. And so what that speaks to is obviously gold and commodities do very well. If you want to preserve your purchasing power post bust, that's going to be your best way to do it.
Mhm.